So one of the questions that I've had to you is like, can you buy a principal place of residence or PPOR or essentially the house that you live in that can also be an investment? Because I look at the places where I want to live and the prices of those places and I'm like, what the hell? This goes against all of my investment philosophies. Like every one of my investment properties does not match much of the data. I could like tilt my head to the side, Charlie, and be like, yeah, totally for capital growth. Sure. But
See, I look at this very differently. I think you're missing a ton of layers even answering that question. So it's like, is it possible to buy a house that is also an investment? Yes, it is.
I would agree with you there. Yes.
Yeah. Does that make it a good decision? No. And in your case, I will say, Grant, like you are a little bit savvy in the idea that you're trying, in your example, to buy blue chip Melbourne property.
Yes.
Right. So some people have that as an investment strategy. The ones where it gets really interesting in my view, right, and we'll come back to your situation because I think it is a fascinating one again. Right. So let's pretend you're a young family and you've got kids and you need support from your parents, but they live in an area that it's like, let's just say is a shit investment. Well, then are you going to buy a PPR in that area to get support with your family? Or are you not? Right?
Yep.
Or are you going to so there's all these situations that would have people need accommodation that isn't a great investment. And what I find really interesting is when people try to justify it as an investment. Really, really interesting. So they'll, in the example here is like, let's say someone has a young family and they want to live near their family so that they can get help with the kids. Common story.
Yep.
And then they'll start saying, well, I wouldn't be paying rent then. At least I'd be paying something down. Like rent money's dead money. And the idea being that if they bought that home there, all property goes up every 7 years. I'm sure it'll go up a little bit. But see how it's now become a compromised decision?
It's using general statements.
Yeah, because they don't acknowledge that if you bought a house in that area, is the idea being that, well, that's your borrowing power tied up. It's actually opportunity cost in you could have bought other investments to do so and maybe rented in that area if appropriate. Or for other people, this was a huge one for us, is like with kids coming along, we wanted to be in a home we owned.
Yep.
Right, so we didn't want to rent when we brought Jack into the world because it was an emotional need. It wasn't a logical need. So these are the ones, but to that point is like it becomes really, really fascinating. I think a lot of people delude themselves into this like hybrid thing where they can get the best of both worlds, but they actually get a compromise of both. And it could be often significant and detrimental. And the idea of doing that is just very, very, very hard for people to, how can I put it? They want the Goldilocks scenario, but it's very rare does that exist.
Yeah, it's almost close. There was a scenario that I was running through the back of my mind, Charlie, on this, right? So my parents live in Gippsland, Victoria, and ideally, Hazel and I want to buy in Bayside, which is near sort of the Bay in Melbourne. And I'm looking at this, and I'm like, okay, from any time, we'll call it a couple of years ago, before I had investment properties, I would look at Bayside now, and I would be able to convince myself that it's a great investment. Just because
it has been. If you historically look, you could do worse.
That is a fair point. But then I look at it, and now that I've got investment properties and I've got this experience of what to look for, what not to look for, what things seem to increase the value of a property and increase potential rents versus not, etc., as well as the concept of investment property versus a house that you buy, I start looking at this going, oh my gosh, if I go and borrow like $1 million, 1.5 million, I'm like,
where are you borrowing $1 million and getting in a Bayside? Let's be real. If you got a house, you want it as a PPR in the southeastern suburbs that I know you're looking at, you're cutting a check $2 million plus minimum.
Shh, I'm trying to be relatable. So then from there, I'm like, you know how many investment properties I can get for that, Charlie? You know how tied up I will be to not take the moves that I want to take in investment properties to go and purchase that. And it's the thing that plagues my mind is, do I want to have that now, noting that I think it might increase, But like that's a swing of the bat for the next 10 years, unless I earn substantially over the over the next couple of years out of the business. But I'm like, that is like a decision that has second order consequences of like, well, you are now handcuffed for the next 10 years. And that was the thing that killed me, because I think if I rewound a couple of years ago, I'd be like, let's do it. Because I wouldn't understand the second order consequences. I wouldn't understand, well, what am I actually giving out? So it was one thing to look at, is this a good investment for the house itself to increase? And you've shared that, yep, Bayside's done quite well. But the other thing was like, well, what else is it actually impacting? And it was all of these other things where I'm like now leaning on I think you, to your point, I think you can buy an investment, but it comes down to like, is it going to be the right play for you?
Completely hamstring you in multiple ways. So let's go deeper in that. Is like, let's pretend you bought a property for $2.5 million in the southeastern suburbs of Victoria. Completely doable, by the way.
Totally doable.
You could spend a lot more than that. But the idea being of like, it's not just that it stops you from, it may stop you from investing because your borrowing power is tied up, right? Yep. It's also the idea that it may handcuff you to work or employment or a job that you now have to earn at that level to support that mortgage. So all your income is now tied up supporting that debt as well. And that can be very challenging for people if they're not in a career or business that would have them be okay with that. I've actually valued flexibility a lot in my own personal circumstance. That's probably one of the things that's stopped me from buying a massive house or over committing myself, is because I like the ability to change what I'm doing for work and have some flexibility with what we do in business. There are some pros with it as well. We'd have to acknowledge, though, is that you do get the tax-free capital growth. So if you were to invest in a blue chip suburb of Melbourne and historically remained the same trend, you could make some significant gains, on your actual like paper wealth position over that time in the next 20 years, potentially, let's say. But that's kind of your trade-off, right? It's like, am I going to take the tax-free capital growth that I have to support the debt? Could be challenging, could work out. Versus, am I going to invest more in other assets where it's got a rental income and have less, what we call it, personal debt?
So essentially, I kind of landed on this point where, in my view, as of the moment, it's like a house that you live in can have a component of it being an investment grade house, but the majority is it's an emotional purchase. You're looking for somewhere to raise a family. You're looking for the place that you want your kids to go to school. You're looking for that thing. I think in the way that I view it is, Grant, it is close to impossible for this house to be an investment. You need to buy an investment property for it to be an investment. I said, this thing can increase in value, yes, and I can buy the right house on the right street, yes. That is just a component of what is an emotional purchase. Like for me, thinking that this property is going to be the best investment and use of my capital, I'm probably not going to buy an asset that me and my wife want to live in, or me and my wife want to raise kids in. Like, I think that if I want an investment, just fucking buy an investment property. If I want a house to live in, just fucking buy a house to live in. Don't try and sit in both camps, because yes, you might be able to find it, but oh my gosh, will you rip your hair out trying to figure out where it is, the compromises between the suburb you want to live in versus the best investment.
You won't find it. It's not findable. It's a compromise decision. It's like, it's complete. Do I want to go up or do I want to go down? You can't do both. Like you will always find some compromise on that.
And that's where my head landed. I'm like, sure, there is a component that can be an investment, but this is a house to live in. Is a freaking house to live in. Stop trying to tilt your head and sell yourself, Grant, on it being a good investment. You're buying a house to live in a suburb that you want to live in. Like, just accept it for what it is. If it goes up, great. If it goes down, great. It's just you want to live there. That's it. Call a spade a spade. Stop being a dick. And that's what I said to myself.
I think of it in similar lens, but a little bit differently. And I'll express why is I just don't rely on it. It's not the part of my strategy I rely on. Like, I'm not going to intentionally buy an asset to live in that will go down. Like, I just wouldn't do that. If I was going to let's say I needed to live in an area that I was pretty convinced the asset prices were going down, I would rent. It doesn't make any sense for me to purchase unless forced to, but that is unlikely with my life circumstance. So if for whatever reason that was the case, I would rent in that area and invest elsewhere. Now, on the other hand, and if I was going into, let's say, wanting to live in an area, I would be very cautious of just not maxing myself out with that is my only investment.
Completely.
Because if it is compromised, I'm probably going to be sacrificing returns elsewhere. So personal view and opinion for me is that I don't want to buy too much house that I can't invest outside of my house sufficiently where I don't have to rely on it at all. This is like a nice little icing on the cake. Now, you totally can still do reasonably well, and I have. Like the PPR I bought has actually tripled in value since I bought it. But that was luck. That wasn't intentional. So that is something that I bought a home when I was about 22, maybe, around then. So I've had it more than 10 years now, and it's just so fortunate that by chance, because again, it wasn't an intentional investment, but that's actually, I'll say near tripled. I won't say tripled. It's near tripled over the last, let's say, 12 years or whatever I've had it for. So you can definitely do well out of it. That's the point.
Yeah, and but that's the thing, right? Like if I was looking to buy a house before I got into investing, I would have probably done something similar, right? But now that I've done investing and I'm looking at a house to purchase, I factor in so many other things now. I'm like, it's just as would you. Like imagine you were to sell that place and say, let's go and buy another one. You would factor in different things than when you bought your house of residence originally.
Yeah, to the point of this conversation, just accepting it as a place to live as the priority and valuing in that way.
Exactly. Call a spade a spade. All right, fellow property investor. If you loved the value from this short video and wanted to know more about how you can win at property investing, check out the full episode by clicking the link on your screen or in the description right now. Alternatively, click subscribe and you'll never miss another one of these videos.